for joining today's session of the Federal Assistance E311 program. We started this program when we were first responding to COVID and figuring out how cities could access federal funds to help with your emergency needs. We've been with you through the CARES Act money and what eventually became the American Rescue Plan Act. And we're now approaching a really pivotal moment, which is the upcoming obligation deadline, December 31st, 2024. And so we want to make sure, and we put this session together to make sure that you feel completely prepared for that obligation deadline. And we have our fantastic partners at the U.S. Department of Treasury joining us today to be able to provide you up-to-the-minute information, a review of some of the guidance, a reminder of what you need to do with that deadline in mind. And so without further delay, I'm going to turn it over to Vero Soto, who is the director of the State and Local Fiscal Recovery Fund program at the U.S. Department of Treasury. And just a huge thank you to our partners at the U.S. Department of Treasury and to, of course, our wonderful partners at the U.S. Conference of Mayors for making sure that cities have what they need in this moment to respond and to be able to really bring federal funds into action in your communities. So I'll turn over to you, Vera.
Thank you so much, Jamie. So for everyone on this call, welcome and thank you for joining the session on the State and Local Fiscal Recovery Funds program. And thank you to the U.S. Conference of Mayors and Bloomberg Philanthropies for bringing us together. As was mentioned, my name is Veronica Soto. I go by Vero, and I serve as the director of the State and Local Fiscal Recovery Funds program. So on the next slide, you're going to see our agenda for today's conversation, and we'll start with an overview of the SLFRF program and the obligation deadline of December 31, 2024. We will share highlights from recent reporting data and demonstrate how you can explore the data yourself. Then we'll provide an overview of recent guidance that updates the information on obligation. We're going to touch on interagency agreements and revenue loss, among other frequently asked questions. We are going to focus in particular on a common reporting issue we've seen that's associated with the revenue loss eligible use category. I encourage you to listen closely to see if your government might have made a reporting error around that area. So please note, the statements of the participating entities in this presentation are their own and were not made on behalf of the Department of Treasury. This is intended solely to assist recipients of SLFRF funds and should not be viewed as an endorsement by Treasury of the participating entities or their statements. And with that disclaimer, I'm going to turn it over to my colleague, Mira. Mira?
Thank you so much, Vero. Hi, everybody. Great to see you all. Thank you so much for joining. So as you all well know, the SLFRF program was authorized by the American Rescue Plan Act, and it provided $350 billion directly to communities like yours to respond to the pandemic and to build strong, resilient, and equitable recovery. And we've seen states, territories, local governments, and tribes each addressing their own needs, with $45 billion allocated directly to metropolitan cities, and nearly $20 billion to additional smaller local governments. On the next slide, I want to just touch briefly on some public data that was released this fall, and it demonstrates what folks are doing with these funds. So this is quarterly data as reported to Treasury through June 30th. So you will see quarterly reporters in this set of data, not annual reporters. And in this, the states and largest cities and counties have reported budgeting 95% of total SLFRF funds to specific projects. And the number of projects has grown 7% since the previous reporting period, demonstrating continued steady progress in recipients' planned use for these funds. We've seen SLFRF recipients report $353 billion in lost revenue resulting from the pandemic. And a significant portion of this revenue shortfall is being made up for with SLFRF funds. More than 22,000 participating governments reported that they budgeted nearly $136 billion in SLFRF funds to help replace this lost revenue, and have funded more than 83,000 projects to provide fiscal stability in their jurisdictions. On the next slide, there are a couple highlights we wanted to bring to mind, given issues that we know are very important to you and your communities. This was published, this is the data that was published, as I mentioned, on our website, October 18th. And I want to call out recipients' investment in workforce, where recipients have budgeted 13.4 billion towards 3,100 workforce projects that have benefited almost 1.4 million workers across the country. They've also invested 19.3 billion towards 3,100 affordable housing projects and over 34.7 billion towards 13,000 infrastructure projects across the country. I want to thank you for your work. This quarter's impressive data really emphasizes the critical areas that you are focused on in your communities. And we'd love to encourage you to look at the data dashboard that's public on our website for more. So with that, I'll turn it over to my colleague James to show you how you can look at it yourself. Thank you.
Hi, thanks, Mira. I am going to share my screen here. You should see it pop up in just a moment. So this is our homepage. If you scroll down and go to the left side, you'll see a tab that brings you to the public data page. This is where, when you, if you're a recipient, report and information to Treasury, it lives. You'll see the latest release of this data is July 2024, and then prior to that, April. I'll note here that quarterly reporting data is in each one of these releases, but annual reporters only report in April. So if you would like to search for annually reported data, you'll have to access the April 2024 reporting dashboard. Let's go to the dashboard and I'll demonstrate how to work through this data. It may take a second to load because it's a pretty large data set, but it will, when loaded, bring you to a landing page with a map. The summary tab in the upper right-hand corner will bring you to the data, the top line data that Mira just presented on. The recipients and the projects tab is what I really want to cover today. Here you'll see a few columns with recipient name, state territory, reporting tier, recipient type, and then of note, total allocation, number of projects, whether or not they've claimed revenue loss standard allowance up to $10 million, and also if their estimated revenue loss for each year. And then you can also filter by a state or territory recipient type, reporting tier, so tier 1 or tier 2 are in this data set, and then specific
James,
recipient.
sorry,
Oh,
I'm
yeah.
not seeing your screen. I'm seeing someone else's screen. Can everyone see James' screen? I see Terry Lamont's screen.
Yeah, I'm seeing Terry Lamont's
Yeah,
general fund QuickBooks.
I took it off. You should be good now.
I see
Thanks so
James.
much for
thank
flagging.
you.
Are you able to see it now?
Yes, now we can see your screen. Thank you, James.
Okay, awesome. Thank you so much, and sorry for the technical issue. As moving on, you can filter here. You'll see by state or territory or recipient name. So I am from Oklahoma City. I'm going to search that as an example. And again, if you click here, you'll see the city of Oklahoma City was allocated 122.5 million, has reported to Treasury 19 projects, did not claim the standard allowance, but did estimate their revenue loss for each year. And you can see the specific amounts. So this is another way to check your if you're a recipient, your allocation amount in this recipient tab. And you can also view the amount that you've reported as obligated and the number of projects that you've reported as of the date of that report and the date that the dashboard was posted. For more information, you can also go to the projects tab. Again, you'll see similar fields here with the addition of expenditure category group and expenditure category. If we were interested in looking for workforce, as an example, projects, we would filter by expenditure category group 2, negative economic impacts, And then expenditure category 2.10, assistance to unemployed workers. This is the list of total workforce projects. Again, you can filter by recipient name. So I will filter by Oklahoma City, where I'm from, as an example. And you see that they've reported that project with the adopted budget, total obligations and expenditures, completion status, and a project description to the side here. I'll note here specifically, and we'll get into more of this when I turn it over to Vero, but you can also look into if you have associated obligation or expenditures with a revenue replacement expenditure category project. And so that expenditure category is EC6. So you can filter again by EC6, see the projects that specific recipients have reported under that. With that, I'm going to stop sharing, and hopefully we can bring back up the slides and resume the presentation here. So if you scan the QR code in the lower right-hand corner of the slide, that will take you to the SLFRF FAQs and will allow you to follow along as I reference them throughout the presentation. The section that we'll be talking about today that is relevant is section 17, which covers obligations. So for all 7 eligible uses, including the provision of government services for funds claimed under revenue loss, recipients must obligate funds by December 31st. Recipients also must expend those funds obligated for all eligible uses except for surface transportation projects and Title I projects by December 31st, funds obligated for surface transportation projects and Title I projects by September 30th, 2026. So an obligation continues to mean an order placed for property and services and entry into contracts, subawards, and similar transactions that require payment. And there are several pathways via which an obligation can be incurred, and those are listed on the slide here. Many of you may have seen this slide before. If not, I know that this is being recorded. You can read those at a later date, but I'm not going to read them out today for purposes of time. If we go to the next slide, we can talk about what does not constitute an obligation. So again, you can read here what these items do not constitute an obligation. I'll call out a few of them. Specifically, claiming funds under the revenue loss category, including for recipients utilizing the $10 million standard allowance. That does not constitute an obligation. Vero will again get into that a little bit later on in the presentation. But remember, again, that funds not obligated by the end of this year, December 31st, 2024, will need to be returned to Treasury. If we go to the next slide, I want to talk a little bit about FAQ 17.6, which covers the clarification that interagency agreements that meet certain conditions qualify as transactions requiring payment and are thus sufficient to meet the obligation requirement. So if you scan the QR code at the bottom right-hand corner of the screen, you'll find a one-pager with more information about those interagency agreements. If you finalize an interagency agreement by the obligation deadline, you can treat that interagency agreement as the obligations of funds that a government agency will then expend in 2025 and 26. And I'll note that memoranda of agreement and memoranda of understanding can count as interagency agreements, but any agreement must meet the requirements summarized on this slide in that resource with the QR code and further detailed in 17.6 of our FAQs. I want to make another important clarification in the next slide, and where we've received a lot of questions is that all SLFRF funds, including those reported under the revenue loss expenditure category, must be obligated by the obligation deadline. So this means that projects entered as EC at 6.1 projects must meet the same standard as obligation as any other eligible use category of SLFRF. So that includes these revenue loss funds, and just reporting to Treasury that you've claimed revenue loss funds does not mean that they are automatically obligated. Recipients will report revenue loss projects to Treasury through a two-step process, and I'm going to turn it over to Vero to talk more about that.
Thank you, James. So I will go through the question of how does a recipient report a revenue loss project that's obligated? So as James alluded, there's a two-step process. So step one is for the recipient to report the amount of revenue loss they are claiming. So recipients have a choice between claiming up to 10 million in revenue loss under the standard allowance or calculating revenue loss according to the formula that's provided by Treasury. But again, that alone is not enough to report an obligation. Step two is very important. So please pay attention if you have revenue loss projects and need to check your reporting. Under step two, the recipient must report one or more projects under expenditure category 6. You'll hear us say EC 6.1, expenditure category 6.1. So those projects must include the amount of SLFRF funds obligated and expended for that specific project under the revenue loss eligible use category. The project that you submit via reporting must include a project description, and that description must summarize the project in sufficient detail to provide an understanding of the major activities that will occur. The descriptions should establish what the project seeks to accomplish and should include enough information to make it clear how the recipient determined the project's eligibility. So for example, for a workforce project, the recipient might include a sentence like this. This project is designed to provide career pathway and navigation services, workforce coaching and job training and placement to unemployed or underemployed residents impacted by the pandemic. That's a good description. So for a technical demonstration of how to properly report obligating funds used for revenue loss, you can scan the QR code in the bottom right corner to be taken to an explainer video. The video has step-by-step screenshots of what you need to do, and we'll post a link to that video in the chat as well. So I want to emphasize here that without completing step 2 and reporting those specific projects for which the recipient has obligated funds, those funds will not be reported as obligated. Just electing the standard allowance is not sufficient to show obligations. Finally, I want to note that if the recipient is using SLFRF funds under the revenue loss eligible use category, in order to benefit from streamlined eligibility and reporting requirements under that category, the project must be reported under expenditure category 6, so EC 6. And if the project is reported under a different expenditure category, then Treasury will not consider that project to be under revenue loss eligible use category, and the project will be subject to more detailed reporting and other requirements. So to stress this point further, in the next slide, let me show you an example of an issue with a reporting of SLFRF funds under the revenue loss eligible use category. Now, this is from a PDF of a submitted report, so it's a real example. And so you can see here that the recipient completed step 1 that we just discussed. So you see the section called revenue replacement, where they reported they were electing the standard allowance of 10 million. And in the box of explaining how revenue replacement funds were allocated to government services, we've redacted that here. They do provide a detailed description of the project they plan to use the funds for. However, as we just discussed, This is not sufficient to show an obligation. That is why you can see in the red circle at the top in the overview that the recipient's total reported obligations are listed as 0. So recipients must complete step 2. As with any other SLFRF funds, they must obligate the funds to be used under revenue loss eligible use category. And they must report those obligations to Treasury through reporting an individual project or projects in expenditure category 6. The total amount recipients report as obligated is the sum of the obligations across each individual project. So this recipient did not report obligating any funds through individual projects. And as a result, they inadvertently reported 0 in total obligations. And each of you can check the last page of your latest report submittal in PDF format to see how much your community has reported cumulatively for obligations and expenditures and how many projects are included in your reporting. One additional note, since it is a question we are seeing in the inbox recently, so reporting the obligation is different than actually making the obligation. As James outlined earlier, your SLFRF funded projects must still meet the definition of obligation and do so by the deadline. And you keep that documentation in your files. Treasury, an auditor, an oversight body may request that information later. So a quick example, if you have questions about how to ensure you meet the definition by the deadline, is the following. Suppose your community entered into a contract and that contract is signed on November 25th, 2024. That contract meets the definition of obligation. However, if that contract gets signed on January 10th, 2025, that does not meet the definition of obligated because that's past the deadline. So back to reporting. In the event that a recipient believes they might have made this or another reporting error, you may update your report during the next reporting cycle. We're getting a lot of questions about that. How do I fix it now? Well, our reports are open only during the reporting period. And so you do not need to show your obligations right after December 31, 2024, especially from annual reporters. So note that the chance to report obligations made by the obligation deadline will actually be January 31st, 2025 for those that report on a quarterly basis, and it will be April 30th for those that report on an annual basis. And to find out if you're a quarterly or annual reporter, you can see our compliance and reporting guidance on page number 20. And I want to emphasize that the reports you submit are cumulative. So the Q4 2024 report that's due for quarterly reporters, or the 4th annual report for those that report on an annual basis, they include all obligations and expenditures from earlier in the period of performance for SLFRF. And if you did not correctly report earlier obligations and expenditures, you can update that in the upcoming report, even if they covered a period before the one that the report is supposed to cover. So with that, I want to thank you for joining us here today and thank the U.S. Conference of Mayors and Bloomberg Philanthropies for collaboration in this important area. The Treasury Department is very focused on ensuring that recipients can leverage their award funds for SLFRF to meet the unique needs of their communities in ways that will power inclusive and equitable economic growth for decades to come. And we don't want to ask you to return funds that are not obligated. So we look forward to having you join us at future educational sessions to learn more about resources and guidance on how to meet the obligation deadline for SLFRF funds and how to report it correctly in reports due after December 31st, 2024. So please continue to share with us impact stories of how your communities have benefited from these programs to SLFRF stories at treasury.gov. And if you have questions in the meantime, you can contact us at slfrf@treasury.gov. Thank you so much. I'll hand it over back to Jamie and the rest of the team. Thanks a lot.
Thank you, Vero. That was really, really helpful. We're getting hundreds of questions in the chat. So we're gonna just gonna promise everyone we're gonna answer as many as we can during today's session. Some of them were just answered by the presentation from Treasury, but it seems like some clarification might still be needed. The one piece that Vero just touched on around what do you do if you don't report until April? How does the obligation deadline impact you? I think Matt Hansen, who we're about to hear from, is going to cover that. He's covered that in the chat, but just want to make sure that everyone understands that we recognize that there's some confusion there, and we're going to be getting to as much as possible. So I'm going to I want to thank our Treasury colleagues for joining us today and for populating the chat with additional information. The recording of today's session and the slide deck are all going to be posted on our website, which I've posted a few times in the chat. And just know if it seems like some people are having a little bit of technical issues seeing the screen or hearing properly, the recording will have it all. So if you've missed anything, don't fret. You're going to get connected with that information. Next, I'm going to turn it over to someone who has been helping us since day one interpret all of the rules around this money, Matthew Hansen at Witt O'Brien, and he's going to provide some strategies. And then we're going to do lots and lots of time for Q&A. So I'll turn it over to you, Matt.
Appreciate it, Jamie, and appreciate the U.S. Conference of Mayors and others putting this session together. I'm going to go off script just a little bit and talk about what I put in the chat, which seems to be a concern of many individuals on the call. You don't obligate your funding through Treasury reporting. The 12/31/24 obligation deadline is not a reporting deadline. As Treasury just mentioned, for quarterly reporters, your next report won't even open until January 1st. For annual reporters, your next report won't open up until April 1st. The obligation deadline is an internal obligation. You need to demonstrate obligation via internal documentation, not through the reporting to Treasury. So what does that mean? You need to have copies of interagency agreements, copies of contracts, POs, payroll expenses, subrecipient agreements, beneficiary agreements in your files fully executed by 12/31/24. Those are not documents that you're going to ever upload as part of your Treasury reporting portal. They're documentation that you need to have in your file. So when your single auditor or somebody from Treasury comes and monitors, that you can provide those documents to show that you obligated by 12/31/24. So the reporting is critical from a compliance perspective, from an accountability perspective, but that is not the 12/31/24 deadline. It is making sure you have that documentation in your files. I just want to say Treasury has given us all the tools we need to meet the obligation deadlines by 12/31/24. They've given us the ability to use interagency agreements, MOUs, MOAs, contracts, subawards, beneficiary expenses, and even the cost estimation methodology for admin expenses. So there's really no excuse why we're not able to fully obligate by 12/31/24. It's just making sure that you have those documents in your files fully executed, and then we can catch up and do the reporting piece, whether you're a quarterly reporter or an annual reporter, the next time the window opens up. There was a lot of discussion about claiming revenue loss. Please make sure that if you claimed revenue loss, if you claimed the standard allowance, that you then go that next step, as was explained, to create a project under expenditure category 6.1, put in an obligation, put in an expense, the next time the reporting portal is open for you. My biggest concern for folks that are using revenue loss is that they've literally just taken the money and deposited in their general fund, and there is not any supporting documentation internally where that money went. So if you use that money for payroll, if you use that money for supplies, please make sure that you have payroll records, invoices, POs, whatever the case might be, that ties those expenditures back to the ARPA funds, back to the revenue loss funds. You cannot just deposit it into your revenue loss or into your general fund and call it good. So make sure you have that tie back. Right now, if you're having to, look and recreate some of that records, that documentation, please take advantage of the MOA obligation strategy. So you have positive documentation for obligation strategies while you go back and recreate those records. But the revenue loss money has to be used for a programmatic purpose. And in using it for a programmatic purpose, you must have the documentation internally to show how that obligation took place and ultimately the expenses take place. That being said, and we'll get into a lot of this in the Q&A. Just a couple slides really quickly. Last minute obligation strategies. We're at the point now, you can't overthink this. So if you still are trying to make funding decisions, prioritize high impact, quick to execute activities. Look at projects already underway, projects in your pipeline. Focus on projects that are close to completion that might need additional funding. Quick procurement options, using payroll, credit card transactions, expedited POs, pre-approved vendors. This is a quick tools to quickly obligate and then ultimately expense these transactions. I know not every jurisdiction can use credit cards or some of these, but use the tools that you have available to you from a procurement perspective. Really now is not the time to go out and do net new procurements. So look at existing contracts or agreements that you have. Can you piggyback on them? Can you amend them when you have to demonstrate obligations at the 11th hour? If you do need to do a net new procurement, at this point, I would probably make sure I did the interagency agreement MOU strategy, so I had that in my back pocket in case the fast track procurement ultimately doesn't happen. But avoid complex bidding. Whenever possible, utilize cooperative purchasing, and then use templated professional services agreements and other contracts. One of the things we always see is when contracts go back and forth and they're being redlined and lawyers are looking at them on both sides. They're looking at insurance indemnification, and what we thought would be a contract that we could sign in a couple business days takes weeks or even months. So at this point, stick to templated agreements and things that are going to go through as quickly as possible. To my earlier point, document everything. You meet the 12/31/24 obligation deadline through your internal documentation. So, have emails, copies of contracts, purchase orders, any communication with internal departments around IAs, MOUs, MOAs, communication with vendors, subrecipients, beneficiary, payroll records. Ultimately, that's how you're going to demonstrate that the obligation occurred by 12/31/24. And down the road, ultimately, that's how you're going to demonstrate that the expenses happened at the proper time. So make sure you have adequate document controls. If you have multiple people working on this, make sure they're coordinating and they're using a Dropbox or a SharePoint site or a team site or whatever, so that everybody has access to these internal documentations. Because then, again, that's what the auditors are going to look for. That's what the Treasury program staff, Treasury OIG, the PRAC, they're going to be looking for the internal documentation to demonstrate that obligations happen. Report now if you have an outstanding report. So if you're delinquent on your last quarterly report or your last annual report, that report is still opened if you're delinquent. And I strongly encourage you to go in and take care of that delinquency now. I worked with a city clerk yesterday from Bassett, Kansas, population 26. She had a delinquent annual report, was able to go in and help her upload that report and bring her community into compliance. If you don't have a delinquent report, if you submitted your last quarterly, if you submitted your last annual, then there is nothing you can do in the Treasury portal, as we discussed, until the next reporting windows open, either on December 1st for quarterly, or January 1st for quarterly reporters, or March 1st for annual reporters. But if you have a delinquency, if you have not submitted that past report, please take care of that now. That's a critical compliance step as part of managing your grant. Next screen. So I know we're going to get back to questions about meeting the obligation deadline. I just wanted people, we're almost at that point where we need to be thinking about what happens once the obligation deadline is passed. So Treasury, again, in the compliance materials, has given us tools to make adjustments, to make tweaks after the obligation deadline. So be thinking about tracking the need for change orders on projects that you have, contracts that you have that were obligated, including cost adjustments. We're in the winter season. We're going to see projects delayed from weather delays. We're seeing supply and labor costs go up because of inflationary process. Site cost, you get into a water line project, you get into a capital project, and you suddenly find out that there's remediation or something else that needs to happen. Those are all going to drive up the cost of projects that you've obligated, that you plan to use ARPA funds, usually result in a change order. Start tracking that. Make sure you have a process for staying on top of that. Amend existing contracts. If you have funding come back from projects, you thought they were going to spend X and they came in under budget, and now you have funding available and you're after the obligation deadline, you can look at those other projects, those other contracts that were obligated with ARPA funds to see if there's additional funding that you can place on those projects, so you're not losing out on that money. Replace existing contracts altogether. Just because you obligate a particular project or contract by 12/31/24 doesn't mean you're locked into that. If that project doesn't happen for some reason, you are still able to reutilize that money and put it onto another project that met the ARPA obligation deadline. Maintain, and to this point, maintain an inventory of potential replacement obligations, projects that met the 12/31/24 obligation deadline, they meet the state and local fiscal recovery allowable purposes, and have met or what would meet the federal compliance standards. So be thinking about your plan B, your plan C. We don't want any money to go back to Treasury because we missed the 12/31/24 obligation deadline, but we also don't want any money to go back to Treasury in 25 and 26 because we didn't have safe harbors or places to put money that becomes available from projects. So be thinking through those alternative plans. And then, as I said on the first slide, I will say here, document everything, ensure proper documentation. These deadlines for obligation, these deadlines for expenditures, you demonstrate compliance with your own internal documentation, not with the reporting to Treasury. So I cannot emphasize enough how critical the documentation requirements are. And with that, I think we'll, Jamie, open it up for some questions.
Great. Thank you so much, Matt. We've gotten an abundance of questions. And so what I'm going to try to do is I've tried to categorize some of them, and I'm going to hit at the top the ones I think are the most important for this upcoming obligation deadline. If we don't get to one of your questions that you've asked, and it's really about some of the reporting or admin, we will get back to you right after this call and make sure that you get that connected set information. So we're going to start with one of the themes that's emerging is what is enough to prove an obligation. So people ask, is it an invoice? Is it a purchase order? Who needs to sign it? Does the vendor need to sign it? What about a signed contract? So could you maybe just, Matt, talk about, what satisfies that obligation documentation requirement?
So it's a finalized fully executed version of whatever. So an interagency agreement, MOU, MOA would be from one city department to another city department, fully executed by both parties. A contract, a PO, an invoice would be whatever the version is of what your jurisdiction considers a formal finalized procurement. Subrecipient agreements are a little bit easier because you can look to the federal uniform guidance and the requirements of pass-through entities of what needs to go into a subrecipient agreement. But again, that's a fully executed, you, the city, town as the grantor, and the subrecipient as the grantee. Same thing with a beneficiary agreement. As far as self-performed or internal, something like payroll, it could be a copy of your payroll records. It could be a general ledger. It could be a certified payroll, an Excel file that's signed off by the head of HR. So there's not a one size fits all, but it can't be an email that says we plan on spending $5 million on payroll. Like you need to be able to tie it back. And if some of that documentation doesn't exist, you might have to go back and recreate it. And that's, doing an Excel file that shows that these 10 employees, billed their salaries during these pay periods to the ARPA funds, and then it's signed off, by somebody of authority within the city and town. So you all have gone through, some form of audits before. You kind of have a sense of what either the state or your own auditor is looking for. But there is not a, one size fits all document that, would demonstrate. It's something that you feel comfortable adequately documents that an obligation occurred.
Great. We're going to turn to eligibility because I think that's also an important topic here. We got a question: can money received be used to pay a loan that was taken out to improve our water and sewer system? If not, can the money be used in order to make improvements to water and sewer?
So I would refer you back to the FAQs. There are some specific prohibitions on use of funding, even if you're using it under revenue loss, and debt servicing is one of those specific prohibitions. The second half of the question is easier. It's a no-brainer that it is a presumptive use of ARPA that can be used for water, wastewater, sewer, stormwater improvements, just not on debt servicing on those projects. So anything net new going forward is certainly allowable.
Great. Staying on the eligibility category, can a municipality use 6.1 funds to totally replace a payroll or fringe benefit line in their budget?
Yes. Payroll, fringe benefits are a government service. So, under the revenue loss 6.1, you certainly can do it. But you do need to document, that whichever line of, if it's all of public works salaries or police salaries or whatever, that they are in fact hitting those revenue loss funds and they're not just hitting the general fund.
And so just want to underscore, we gotten a couple of questions about obligating for law enforcement payroll or purchasing equipment for a water department. It sounds like those would have the same answer.
They would, and you still need, like, if there are transactions that have happened before 12/31/24, the obligation and expenditure already happened. It happened with the payroll records, it happened with the invoice, the PO. But if it's transactions that are going to happen after 12/31/24, you still need to make sure you obligate it for that future purpose. So if they're internal, city and town activities, you can't just obligate them through, city council resolution or minutes or a budget staff meeting or memo. They need to be obligated through an interagency agreement, MOU, MOA, if there are actual expenses that are going to happen after 12/31/24. So please make sure you're taking that added step and you have that documentation in your files.
Great. We got a question. We have designated the funds for the fire department that serves our township. Because of COVID, they were unable to hold their primary fundraisers for 2 years. Is this an eligible use of these funds?
Yeah, I mean, the short answer is yes. There's a couple different ways to go about it. Revenue loss is one way. Negative economic impact to the fire department is another way. So there's some additional steps to figure out how you determine allowability and what expenditure category you report it under. But if you're a smaller jurisdiction, and you can use 100% of your grant award under the $10 million revenue loss, that's certainly the easiest, but it is definitely an allowable use of funds.
Great. Staying on this theme, but thinking maybe about how it affects reobligation. We got a question. We mostly have used infrastructure funds with well-designated POs. Can we move funds down the road after we obligate funds on December 31st, 2024? This is because funding needs for infrastructure may change on the road.
So you have that flexibility, but it has to be moved to other projects that meet all the ARPA criteria. So you can't just introduce a net new project because suddenly a city council member wants to make renovations to a park. Like it's within a universe of projects that already meet the ARPA obligation. They're eligible projects and they meet or they would meet the federal compliance requirements. But you do have those flexibilities, and Treasury in the FAQ has laid out the various scenarios for you.
Great. We're going to shift a bit because we got this question that I find troublesome. Our state regulator said that counties or cities might report revenue loss in EC 6.1 by saying something like, City of called Smithville used ARPA funds to provide general government services from March 2021 until exhausted. Dozens of counties and cities in our state are using that language. Is that permissible?
So again, we need to differentiate between meeting the obligation standard and the reporting standard. So using generic language like that is certainly allowable in the reporting portal. Treasury will likely come back and want some additional information as part of their monitoring or their annual reporting or whatever. But from a reporting portal perspective, absolutely generic language like that is fine. It's in how you actually obligate it and the documentation you have in your own files that I'm more concerned with. So that's to our earlier discussion about you can't just dump the revenue loss money into the general fund and use it until it's gone. It's still got to be programmed. It's still got to be used for a specific purpose. That specific purpose might be payroll. It might be, tools for public works. It might be supplies. It might be, but it has to be a specific purpose. It can't just sit in the general fund and get used up like other municipal general fund money. But as far as the generic language in the reporting portal, that's not going to impact one way or the other on whether you've met the obligation deadline of 12/31/24 or not.
So maybe this, let me know if you think that your last answer answers this question. I'm confused about the obligation. If you take the $10 million exemption into your budget, do you still have to list the obligation?
Yes, absolutely. So all the claiming of revenue loss does is it opens up the allowability, the eligible uses you can use the money on. So by claiming revenue loss, you go from only being able to use it for the specified purposes, and these were premium pay, they were water, wastewater, sewer, they were broadband. I mean, by now those. By claiming the revenue loss, whether you calculated it or you did it at the standard allowance, it allows you to now use the money for the provision of government services. So it opens up this whole universe of how you can use the money. It does not, however, wash away the obligation requirement, the expenditure requirement, the reporting requirement, or that the money needs to be used for a specific programmatic purpose to demonstrate that an obligation and expense happened.
That's great. And I just want to recognize in the chat that we're getting a lot of people who are saying, I'm new in my role and I don't really know what my predecessor did before. And I'm a little worried that they may not have done all the things we need to meet our obligation deadline. And so we're going to just as a program take that back and figure out what we can do to support those of you who might be in that category. I'm not sure we'll be able to fully solve for that today, but I want to know you've been seen and we're gonna try to figure this out and figure out how we can support you.
And I understand there's been some frustration in some of the comments about the Treasury help desk. I will tell you that in my experience, when I've called them, they have been incredibly responsive. I think the volume of the email is just overwhelming. So calling them, there's a hotline number on the Treasury website, is definitely the way to go. And for those that you are inheriting a grant, the first thing, the most important thing to do is to get access to your city or town's Treasury reporting account, because then you can go in and see, what the full award amount was. Are they delinquent on reporting? What's been obligated to date? Like, that's a critical step. So if you're looking for the place to start with, getting in contact with the Treasury help desk, getting access to the portal, and going from there. And that really will set the foundation for everything else going forward.
That's great advice, Matt. And we'll collaborate with our Treasury counterparts on what can we send you all to help you at least take that first step to get into the portal, because we know that you can't do much until you even see where you're at. Okay, next question. May we obligate more funding than we are receiving from SLFRF if we project a cost overrun?
So you certainly can. Again, we need to differentiate between the reporting and your own files. So the Treasury system will not allow you to report obligations in excess of whatever your award amount is. You'll get an error message. But when you're entering into an interagency agreement, when you're entering into a contract, using language that is up to X amount that might exceed your available funding, or language that says, before we begin phase 2, we'll certify that there's no remaining ARPA funds available. All of those strategies are things that you certainly can put into your own internal documentation, and be able to point to those obligations as having occurred before 12/31/24. So the Treasury portal won't let you do it, but you can certainly do it with your internal documentation.
Great. And we're going to continue the Q&A going, but I'm also going to put up a poll for folks that you could be filling out while you're listening. And one of the things that we offer on there is some one-on-one assistance. We'll also try to, if you have similar questions, we'll try to group you and do some coaching through office hours. Great. Our next question, and I might wind up not hitting all of the reporting questions, but just know, especially for you April reporters, we can hold a session that specifically talks about that even after the obligation deadline. But remember what Matt said, obligation deadline applies even if you don't make a reporting change until April. Let's do this one next. How about if funds have been obligated and spent to acquire land for affordable housing, but the project has not been built yet, what are the requirements?
If the specific purpose was the land acquisition, there is no completion requirement. Certain federal grants have a requirement that the entire project be completed, within the project period or the end date. The Treasury funding does not have that requirement. So, the project in and of itself could be the acquisition of land for future affordable housing development down the road. There are, I would then look to your own local property disposition requirements in case it was, there's now a different intended use of that money. But as far as having a project completed, open to the public, fully utilized, there are not those type of requirements on the ARPA funds. It is best practice, is everybody's intended hope and goal, but you won't be out of compliance if further investment, further construction activity, ultimately didn't occur for one reason or another.
We got a question. Can we retroactively apply revenue replacement to completed projects?
Sure. Yeah, absolutely. And we've seen that quite a bit where maybe a project morphed a little bit and it's now a little in the gray area of the original expenditure category. Maybe there's been updated Treasury guidance where we thought it clearly fit within an expenditure category, and now we're not so sure. There's certainly been some additional data collection requirements for some of the expenditure categories, and some folks have realized that they, for whatever reason, they don't have the ability to collect the necessary data. So they've moved from one of the traditional expenditure categories to revenue replacement. So you can make those corrections at any time if you have outstanding revenue loss potential. Once you hit the $10 million standard allowance or your calculated threshold, then you would have to, do some sort of trade-off and move a project out to move a new project in.
Great. And I just want to call attention. Vero Soto posted in the chat how folks can get in touch with Treasury for managing access to their account. So please take them up on that. Okay. We've gotten a few very specific questions about I use money for this or I use money for that. I don't think we'll be able to get to all of those today, but I will just maybe suggest sort of going back and listening to the principles that both Matt and Vera have talked about some what's covered, and looking at those FAQs. So things like you've purchased an AED or you've purchased water equipment or you've done all these different things. Is there an eligible use category that those fit under? And then if you met the obligation standards for those, seems to be a framework to use. Okay, we got a question. Can we apply hurricane remediation costs to an ARPA grant? And I'm just going to do a little promotion here. Next week, next Tuesday, same time, 2 p.m., we're going to be having a webinar on funds for disaster relief, including how to use some of our SLFRF or apply for Protect or BRIC grants. So just I'll put information about that in the chat. But Matt, can we apply hurricane remediation costs to an ARPA grant?
So Treasury, in one of its more recent allowability updates, you can use ARPA for certain emergency response activities, certainly under revenue loss. You could always do it. I saw there was one question about, can we use the money for matching purposes for a grant that we won't even hear about until 25, 26. That kind of aligns with the whole, braiding of funds, using ARPA dollars along with FEMA PA or hazard mitigation or some other sort of resiliency funding. The short answer is yes, there are some caveats depending on requirements of, other federal money that you might be introducing into the equation. But even with something like match for a grant that you have not yet heard about, that's where I would use the interagency agreement methodology to demonstrate the obligation. If you ultimately don't get that grant, or if ultimately there is other money made available for emergency response, resiliency, or whatever, then you can back the ARPA dollars out and use it for another allowable activity. So there's a lot of ways, a lot of flexibility to the money. A lot of it comes down to, the documentation and making sure you have that covered.
Getting muted, sorry. Okay, next question is one about, I think we've already covered a bunch of these. Okay, I love this question. We have 1.4 million left of our revenue loss allowance, but the project that we'd like to put it towards will cost $2 million. Can we break the project into 2 entries in the portal to utilize the remaining revenue loss allowance and indicate in the description that they are part of the same project? And I wonder, Matt, for bonus credit, can we also talk about how if you don't have any other SLFRF, how you might be able to use other sources of money for the rest of the project costs?
Yeah, so if the total $2 million to fund the project is coming from ARPA funds, then 600,000 of it would have to be reported under a regular expenditure category. You could report it as 2 projects, or you could just report the entire 2 million under that expenditure category. Because you claim the standard allowance does not mean you then have to have an equal number of projects. You can claim the standard allowance and still report projects under the other expenditure categories. If the delta on the project is not ARPA, you would only report the 1.6 million. So from a grant perspective, it's just a 1.6 million or 1.2, whatever the number was, project. So you would only have one reporting entry, not needing to break it into 2. This is still, we're up against this 3-week deadline. This is still the most flexible federal funding you're ever going to see. So, really, still think strategically about how you can braid this money with other funding sources, whether that be federal grants or geo bonds or philanthropic money. Normally the rule of thumb is federal funds can't match federal funds. The ARPA funds is different. So, before you button up all your obligations, I encourage you to take one last look to see how you can use these dollars to leverage other third-party dollars that are out there, because it's really kind of a once in a career opportunity that we're getting with this ARPA dollars.
Great. And we empathize with those who are in the chat just feeling lost. That's why we're doing today's session. We'll do as much as we can to help you between now and the obligation deadline. And then frankly, after the obligation deadline, especially where all these reporting questions are coming in. We got a great question of a different breed. Are all projects funded by ARPA required to follow 2 CFR 200 for procurement and purchasing?
It depends between the revenue loss and the non-revenue loss. So I think that's probably a conversation we'd want to have via email or have via one-on-one. I don't want to give blanket guidance. There's also whether the ARPA money is coming to you directly or being passed through from another entity. So, but there are some deviations there, and Treasury has a really nice FAQ where they talk about the portions of uniform guidance that are relevant for revenue loss projects, and that's where I would encourage folks to start if they're looking for that information.
That's great. All right, we're going to get into a few of these reporting questions because there's just so many of them. How can I change the category and subcategory of a project that are submitted in the report?
Once the next, there are a lot of people that want to go in and edit and make changes and do things now, and the answer is you can't. If you're up to date with reporting, you're going to have to wait until the next reporting window. When the next reporting window opens up, again, January 1 for quarterly reporters, March 1 for annual reporters, or April 1, sorry, for annual reporters, then you'll be able to go in and make changes and edits and corrections. The one thing I want people to understand is oftentimes you have to make the same change in several places. So like if you change the obligated amount at the project level, you have to change the obligated amount at the subrecipient level, or you get an error message. So, please don't get frustrated. Once the next reporting window goes in and you go in and you make a change and you're getting an error message, that's likely telling you that you need to change that information in two places in order for the report to validate. But you won't be able to make those changes until the next reporting window. And again, I see a lot of folks talking about, how can I obligate if I can't do my reporting? The obligation requirement is a documentation requirement by 12/31/24, not a reporting requirement. I've also seen a couple comments about city council minutes, agenda items, things like that. Those do not count, meeting minutes, those do not count as obligations. You then need to go the next step, do an interagency agreement, do an MOU, go through procurement, and fully obligate it. Just having council meetings, agendas, minutes, that sort of thing will not serve as an obligation.
That's great. Thank you so much, Matt. We got a question about acceptable wording for legislation. What would you point people towards there? I don't think you're going to be a draftsman on this call, but what would you say are the maybe fundamental elements that one would need to include in any legislation around an obligation?
As far as what would go into an interagency agreement and an MOU, that type of language.
I think that's right.
So there is I think it's a 2-pager that Treasury has put on their website that talks about the fundamentals of an interagency agreement. For me, the two most important things, one is a specific scope of work. You can't just say, we're going to use $2 million for the provision of government services. You need to, have a certain level of specificity. We're going to use it for public safety payroll. We're going to use it for, capital projects and public works. That includes X, Y, and Z. Doesn't have to be, all the project details, doesn't have to be timelines and vendors and everything, but it has to have enough specificity to meet the Treasury standard. And then the other thing is just to make sure that you are specifying in that document that these are in fact, federal ARPA, state and local fiscal recovery funds. And you can do that by incorporating the grant agreement by reference or something, but you need to tie the proposed scope of work from the interagency agreement back to that these are federal ARPA funds. Those are the two most important things. At that point, I would use whatever version of, council resolutions, whereas this happened, whereas that happened, like that really doesn't matter as long as you have those two key elements in the document.
Great. And just want to be cognizant of the fact that we're obviously over the hour. We're going to keep going for another 10-15 minutes. We are keeping track of all of the questions that have been asked, and we'll make sure that we answer all of those, whether it's in a future session or getting in touch with you directly. A question that we got that's different is, what about the interest on the money that is left and being obligated? Does the interest need to be obligated, or do we move it to our general fund and use as we wish?
So two very different questions. Treasury has indicated that interest is not considered program income. So it is completely separate and apart from your ARPA program dollars. So it does not have to be obligated by 12/31/24. You can decide to expend it whenever you want. As far as what you do with it, putting in the general fund or whatever, that is a discussion for you to have internally. There have been jurisdictions that use it to add to ARPA projects. They've used it for other, specific purposes, but it does not have to be obligated by 12/31/24 and does not have to be treated the same as grant funds. That is the interest. There's still program income. So if you're getting program income, tuition on economic projects, rents on small business projects or whatever, that is traditional program income that does impact your grant award. That money does need to be obligated, et cetera, but not the interest itself.
Great. I think we've covered this, but the questions keep coming on, so I do want to make sure we're clear. And it's really about police salaries. Someone asked, you need to select some officers and tie their salaries to the ARPA funds, or can you show the entire police force salaries because the ARPA funds that we received cover a percentage of police salaries, but not all police salaries. And then separately, but relatedly, someone asked to report public safety payroll expenses aside from spreadsheet and reports. Does the city manager need to sign a memo with the total amount?
So it needs to be tied back to an individual. So it could be, you know, an actual amount, it could be a percentage, but it needs to be able to be tied back to an individual. I've seen this done via memo. I've seen it done via Excel. I've seen it done via, you know, a printout from the payroll system that shows what percentage was of a salary and fringe was billed to the ARPA funds versus what percentage was, you know, general fund, law enforcement salaries oftentimes have multiple funding streams, whether they're school resource officers or they're part of a, you know, downtown community safety block or whatever else. So however you track that, but you do ultimately need to be able to show, you know, it tied back to the individual officer and what percentage. Now, you know, we're getting a little bit ahead of ourselves because that's how you're going to demonstrate that the expense occurred. From an obligation perspective, an obligation can be an interagency agreement, you know, from the city manager to the police department or to HR that says 25% of, you know, police salaries are going to be covered by ARPA. You know, that's an obligation standard versus demonstrating an expenditure standard. Those are two very different things.
Great. We also got a question. It's circling back on city council minutes for projects that already went through procurement, are completed or are in process. The council minutes would be documenting that the funds are now being used from ARPA, not the original budget category as when the project was originally approved earlier in 2024. Does that work for obligation?
The projects that have already been fully procured, however you demonstrate that procurement has been completed, whether it's, you know, city council accepting the bid or a signed contract or whatever, that counts as an obligation. For those that are still going through procurement, city council's intent doesn't meet the standard. So you would still, you know, either want to get that procurement across the finish line by 12/31/24 or do the interagency agreement MOU to be that next step to demonstrate the obligation. So elected leadership's intent on how to use the money in and of itself does not meet any of the obligation standards.
Great. And this one I think is interesting. It's specific, but maybe we can extrapolate it more generally. We purchased land for an industrial park with ARPA funds. It is now anticipated that we will receive payment from another municipality via a federal earmark for half of the purchase price. Would that be considered program income? And will we need to re-obligate that amount towards ARPA projects?
It wouldn't be considered program income because it could only be used for that intended purpose, you know. So you would be able to back out that 500,000 of your ARPA money and redeploy it to other projects. So if you know this is happening right now, then I would do an interagency agreement that specifies that once the $500,000 from community X is put into the project, 500,000 will be redeployed for some other purpose. If this happens after 12/31/24, that's when you would have the ability of repurposing that 500,000 for other projects that had been obligated by the deadline, either for cost increases or you know, expansion of scope or a project that meets all the requirements but didn't originally have ARPA dollars in it. You could then put that 500,000 in it. But certainly those things are going to happen, and Treasury has given us the tools and flexibility to accommodate those scenarios.
I think we're gonna dip our toe back into interagency agreements. We have a few people asking, with an interagency agreement, can a city obligate funds to a department for a future project?
Yes, as long as the scope of that project is known. So that's the That's the purpose of the interagency agreement. If the obligation and expense has already happened by 12/31/24, there's no reason to do an interagency agreement. If you've already covered, payroll, if you've already done something, the obligation and expense has happened. The interagency agreement is for future projects, but it can't just say generically for a future project. There has to be some, meat on that scope of work that says for a future water line project, a future ADA sidewalk project, something of that order in the scope of work in order to meet the Treasury standard for a valid obligation having been met.
Great. We're gonna wind down. If you have a urgent question that needs to be answered before December 31st deadline, please feel free to raise your hand at this moment. We'll take one or two more. Just want to again remind folks we're gonna put more information out between now and the deadline. If you requested one time, we'll try to bring you together, particularly with your peers if it's an area where there might be some sharing across cities. And also just want to really highlight for you the resources that Treasury is also been posting in the chat, and we'll add those to the program site with the recording because much of this information is in there, and it's just about making sure that you can wayfind to that. So unless anyone has an urgent, Deanne Mace, do you want to come off mute and ask your question?
Can you hear me?
Yep.
If you have not obligated the $10 million that you have money left over, can you obligate that $10 million out in that category? And lost revenue or whatever that is?
Yeah, if you can fully obligate the total of your grant award, whether that's through revenue loss through the standard allowance, the up to 10 million, whether it's calculated. So yeah, if there's any doubt whether you've obligated your full grant award, please take a hard look at it and use something like the interagency agreement as a placeholder to show that you've obligated the full award. But again, claiming the standard allowance does not mean all your projects need to be reported under revenue loss. There doesn't need to be a one-to-one, but yeah, all that funding you have the ability to obligate at this point up until 12/31/24.
Okay, thank you.
Great, Joanne, check.
Hi. I have a question on the administrative and compliance expenses and whether those should be reported, how they should be reported, and can they go through April 30th of 2027?
So they should be reported. They should be reported under expenditure category 7.1.
Do that.
If not reporting it under 6.1 in revenue loss. So they should be reported. Treasury has given us the estimating methodology as well. At this point, I would do an interagency agreement, an MOU that says, up to X amount to be spent on administrative expenses. And in that interagency agreement, I would put through 4/30/27. I know there's still some debate whether the 12/31/26 obligation deadline or expenditure deadline is a expend liquidate report or not. But I think we all know that there will be reporting requirements, closeout requirements, and single audit compliance requirements after 12/31/26. So should you report as you incur those expenses? Absolutely. Should you budget through, 4/30/27 or whenever you think, you're going to need that support, yes. My recommendation is to do it through an interagency agreement. And then you can make adjustments down the road as Treasury releases more guidance.
Thank you.
Great. Next, we'll go to Danielle Mincy.
Good afternoon, and thank you for this session. I have a question regarding the use of the ARPA funds for a forensic audit. Can we use the ARPA funds, obligate them for a forensic audit, the cost of that?
You can use the ARPA funds, well, I guess a forensic audit related to the ARPA money or forensic audit related to some other activity.
A forensic audit for total operations.
So, yes, but only under the revenue loss provision of government services category.
Okay.
So if your jurisdiction still has capacity under revenue loss, then yes, you could use it for that purpose. Outside of revenue loss, there would not be a pathway for allowability for that activity.
Okay, and what about funds that are can we obligate funds for professional services like contractors who are in the county to help stabilize the county's operations and infrastructure?
Through revenue loss, yes. Through the other expenditure categories, potentially if they are tied back to negative economic activities or water, wastewater, stormwater, broadwind, that sort of thing. So outside of revenue loss, I don't want to just give you a blanket yes,
Okay.
but there are potentially, depending on the scope of work that they were performing.
Okay, so that leads to my last question. You guys are going to offer some one-on-ones, right?
We are, and we're gonna, depending on how many requests we get, we might make them group on one.
Okay, yeah,
Great.
yeah, we're gonna need it. Thank you.
Well, of course. Jenny.
Hi, thank you for taking my question. I'm seeing if I understood something properly. You said earlier, we this year obligated our funds for a fire truck, but through a loan. And I thought you had said that you cannot use it for debt financing. Did I misunderstand that?
You can use it for go forward loan activities. You can use it for, like, if you needed it as a down payment or collateral or whatever else. You can't use it for past debt service. So you can't use it to pay off a debt that you incurred, previously. So depending on how you braided it into this finance activity, as long as it's a go forward, it's likely an allowable use. But if it's paying off an outstanding debt, it would be ineligible.
Okay, so this was a new loan and we specifically were able to enter into it because of the ARPA funds and should be fine?
Yeah, yep.
Okay, thank you so much. Appreciate it.
Great. We're gonna ask our last two questions. Michelle Huvler.
Hi, thank you for taking my question. We had to change the original project that we had submitted because we weren't going to be able to complete it in time. That was originally reported on the 2023 report. So we want to change the project when we report in April for 2024. Can I use funds that were expended? Can I show expenses from 2023 since we're changing projects on the 2024 report?
Yeah, absolutely. So the reports are always cumulative. So you have there's a total obligation, total expenditures, and then there's a obligation and expenditure for this period. So it would just, those 23 expenditures you would report in the total obligation, total expenditure category versus what you would put in for this period. But you'd be able to make all those corrections once your next reporting portal opportunity is open.
Okay, and this was a bond issue project, so it's still okay that we use the money in conjunction with that?
And going forward, perspective, yes. this was and you can go refer to the FAQs. It's one of the very few ineligible activities is to pay outstanding debts off with the funding. But anything that is go forward, you're leveraging the ARPA funds, you're braiding it, you're whatever, that's would be an allowable use.
Okay, yeah, it wasn't to pay off the debt. It was just what the funds were used for with the to do the project.
Right.
Okay, thank you.
Thank you, Michelle. And our last question is going to be from Nevena Chemov.
Hello?
Yes, we can hear you.
Oh, great. Hi, thank you so much for taking my question. I have been trying to figure out how to report our admin estimates. So my payroll are primarily taking care of all the ARPA reporting, and my employee all goes through ARPA. And so we have to estimate our salaries, and not just ours, other departments too. And Treasury's guidelines are a little confusing of how you handle. In one way, they say that if it's an admin, it's automatically considered obligated, but then they provide the expenditure category 7.3, and they say, go ahead and estimate it here. So in Q3 2024, I was very confused how to report this and really didn't report it because I was waiting for an opportunity to get an answer to it.
Yeah, so right now I would really just focus on making sure you meet the obligation, and that is with however you internally have documented, what your budgetary needs are going to be for admin purposes. So I would, if you have a budget of, what you and your staff is going to need and others, I would memorialize that in an interagency agreement, MOU, have that as obligation. And then you can figure out, how best to report it within the 7 series in the Treasury reporting portal the next time it opens. But the main thing is again that you don't obligate through reporting, you obligate through your internal documentation. So to make sure that you have it properly memorialized that X amount of money is being set aside for grant administrative purposes to point to as an obligation of those funds.
Thank you so much, Matt. We're going to have to end it there. We do have to stop at 3:30. I just want to say a huge thank you to Matt Hansen for answering questions from A to Z and to getting so many of those. As I've put in the chat a few times, the recording from today's session and any resources that were shared, including the slides, will be posted to our program website. I'm going to put it in the chat again, just in case anyone missed it. We're also having a session on using federal funding for disaster preparedness, including SLFRF funds, and that is the link to register is in the chat. And we'll be in touch with you all about upcoming supports as you approach this deadline. Thank you to our colleagues at the U.S. Department of Treasury for their consummate partnership and helping cities work through these funding opportunities, and of course to the U.S. Conference of Mayors for bringing this group together today. Thank you all.